You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Welcome back to this week's edition of the Systematic Investor Series with Mark Rzepczynski and I, Niels Kostrup-Larsen, where each week we take the pulse of the global markets through the lens of a rules-based investor. Now, for those of you who are regular listeners, our conversations are intended to give you as much of the nurture and encouragement as the turtles got back in the 1980s, as Jerry likes to put it. And if you're new to the show, we hope that today's episode will trigger your curiosity to learn more by diving into the back catalog and listen to all of the past episodes that you may have missed, like last week's episode with Jerry, in fact, where he discussed how he selects the single stocks he trades in his trend-following portfolio, and where we also talked about why investors tend to gravitate towards lower return strategies with a lot more hidden risk compared to what we do. So if you missed that one, I invite you to go back and listen to it. And as Jerry does, actually, he re-listens a few times to get all the nuances of the discussion. Anyways, Mark, fantastic to see you. Great to be back with you this week. Happy Thanksgiving. How are things going in the U.S.?
Good. We obviously had our big Thanksgiving dinner yesterday. So Friday is always sort of a down day, and it's not because of the markets. You just feel a little lethargic. You had a house full of people. And so this is, it's always sort of, let's say it's a weird day because it's a work day, but at the same time, you don't feel like working. So it's a good time for chatting.
It's a good time for chat. It's always a good time for chatting, right? So I can completely relate to that. Before I dive into my brief market wrap, as always, I just want to remind you listening today that we would be ever so grateful if you would take this link called toptradersunplugged.com/share and share that with 3 of your friends so that we can continue to grow the audience here at this podcast. Now, of course, Fed Chairman Powell's re-nomination, you would think that would be the headline for this week, but while the US is celebrating Thanksgiving, news of a South African variant of COVID-19 is really putting some pressures on the markets today in the headlines that I've seen so far today. And that actually reminds me to say that we're recording Friday afternoon, just so you know. If we leave some news out that comes later on today, we are recording early this week as well. But anyways, the headlines I've seen so far today is, of course, might be old news when it gets to you, but the headlines of this new variant, that it's more contagious than Delta variant and that the vaccines that we've been given may not be so effective against this strain. That is, of course, what's causing these tumultuous times in the markets today. But, it's early days and the headlines will change in the next few days. And now, of course, there is a big sell-off in the markets, and it could also be somewhat, down to the lack of liquidity we see when there is a US holiday like we see today. What will be interesting, of course, is to see if we have investors coming in maybe on Monday to buy the dip, which they have done for so many years now, and that's worked out. Of course, if you're already long Moderna, Pfizer, and Zoom, this may not be a bad day in the office as far as I can tell. But we're going to leave the speculation aside. I wanted to bring you in, Mark, just to hear what has been catching your attention and sort of big picture stuff in the last few weeks since we last spoke.
Well, I think the issue is always that the main topic areas stay the same. It's the nuances that matter. So, for example, Fed policy and central bank policy is always going to be critical. Now we have tapering going on, so we have to look through what are the effects. You look at October was the great repricing of Fed action for 2022, and now we have the further fallout for that. So everyone talks about the Fed. It's just that there's a higher intensity and lower intensity. And I think that now with the COVID, we're getting a higher intensity back for the virus, where it may have been lower intensity about a month ago. So the topics change, the topics stay the same. The intensity differs.
Yeah, and I think that's a great description. Actually, I think if you think back on the topics for the last, probably a few years by now, except for COVID that obviously didn't start until last year. But there's a lot of things that are just going round and round in circles, and we tend to just view things slightly differently from time to time. But anyways, due to just for a little bit of an update on performance on my side, due to Thanksgiving, it has been a really quiet week so far. And performance as of Thursday night was completely flat in our trend following portfolio. But of course, today is not going to be a pretty day because a lot of the trends, as far as I can tell, are reversing. But hey, that's only one day and that's just how it is. My trend barometer has been a little bit weak for a while now. It's still, it finishes yesterday at 36. That's below the average. So it's still pointing to a weaker environment. Maybe it's a little bit ahead of its time. So we'll see how it all plays out into the end of November. In terms of volatility, kind of same thing. I mean, it's been pretty subdued environment for volatility strategies that we've seen all of 2021, really. And it continues in November. And our strategy is down about 1% so far. So not much to report there. But I do want to take the opportunity to mention that this week we published the 5th episode of the volatility series. So if you are interested in the space, and I think most people should be, if nothing else, to learn more about that, because it plays a role even in trend following, I would certainly encourage you to go and listen to these episodes. And also, just to let you know, there are more of these episodes coming, maybe with slightly different characters, but I hope that you'll make the most of this content as well. For my trend following portfolio, where I can go into a little bit more detail, of course, it has been a negative week. It is down about 2% for the month, and it's up about 6% for the year so far. So certainly giving back a lot of the early profits in the year. In terms of the group models, again, before today, this will change for sure today, but the classical trend models were up just shy of 1%. The Group 2 models, so these are the ones with the long bias in the way they trade, they were down 3.37%. And then the fast reacting models were up a little bit, about 36 basis points. Now, in terms of sectors so far this month, the best ones were equities, softs, and currencies. That's probably also going to change after today. And the worst sectors so far were energies, precious metals, and bonds. That may not change actually for today. And if we drill down to the markets, the euro actually, the euro as a currency has done pretty well this month. So has the Nasdaq and the DAX, obviously, again, prior to this Friday. Black Friday is perhaps not such a bad, maybe it should have been Red Friday today. Who knows? And then at the bottom of this month so far, we have crude oil, US 10-year notes, and heating oil. In terms of current exposure, again, the portfolio is generally long, a lot of stuff, equities, copper, gold, bunds, although the bunds is offset by a short US 10-year note position. And then also some of the grains are still long. And then the shorts really around, so the euro and the yen right now. And in terms of the risk to stop, it would the portfolio would lose about 6.99% if we got stopped out of everything, which is down from about 7.91% last week. So again, stops actually it's positions that are fewer, and therefore the risk to stop also comes down. All right, so Mark brought along a lot of interesting topics, maybe a little bit different topics than we normally talk about, which is something we always do when Mark is on the show. There's always a little bit of a difference, so I think you're going to enjoy this a lot. But before we go there, I had an email in today, a question from Glen. Glen used to work as a firefighter and a medic, and he's new to trend following as such, but he does like it, and he wants to implement some of these techniques. So he sent a question in about a system that he has been working on as a general rule, and just wanted sort of a little bit of feedback. Now, it may be a little bit difficult to do it full justice because we've only been given a little bit of the rules. But anyways, Mark, let's give it a go and see if we can help our firefighter slash medic friend, Glen. So he writes, As an aside, because of my interest in your trend following topics, I'm putting some ETFs and ETCs and a few stocks together as markets to trade with my own trend following system. It's a work in progress, and then he shows me a chart below. And what the chart shows is a dungeon channel where the 21-day high line signals an entry to the long side. And then he says ATR at the entry price, which doubled, gives me a stop loss and dictates my bet size. So I think he means a 2 ATR stop loss, and that dictates the bet size. And then he uses a 50-day low line so that when the price goes up and the low line passes the stop, that then becomes my exit signal. So the ATR stop is only as the initial stop, and then the longer term stop will become the 50-day low. Okay, so Mark, obviously this is going to be broad stuff picture, but what are your sort of thoughts, and how may we be able to help Glen a little bit here?
Well, I think let's go back to the basics of what kind of model is he really trying to build. And so if you're looking at these extremes, both on your stop losses and entry level, is that you're fall into one class of models versus another. And I always sort of said is that moving average models are sort of very linear systems. You're either in or out, and a channel system or system of breakout systems where you have to wait until prices get above a certain level before you enter is more of a nonlinear system. So what you're doing is that you're looking for some acceleration. You're looking for behavior that starts to change rapidly. And so by the nature, you're going to have you may get fewer signals because you have to wait for this acceleration. And then you're also going to have a problem is that sometimes they don't extend. So you're going to have an issues associated with that. You might get, false positive signals. So you have to now be comfortable with the type of system that you're building, that you're going to have to do a lot of analysis. You may have to wait for signals to actually appear. So that means you might have to proverbially sit on your hands and just wait and just run your system and not get too anxious. And second is that you have to accept that your probability of success may not be as high as what you would expect. Is that there will be a fair number of false positives.
Yeah. So obviously we don't know exactly how much risk, or we don't know at all how much risk that Glen is using per trade. But one thing that kind of caught my attention is just that he's using a relatively short look back period, 21-day high. For me, that's a short look back period. But then he uses a 50-day low as the exit. Now that may work well. I mean, and maybe Glen has tested this, but usually I tend to see that people are using a larger number in terms of look back for the entry. So like 100-day high combined with a 50-day low as your entry. So I noticed a slight sort of reverse sizing, if I can call it that, of the parameters here. Again, it may work well, but that's one thing. The other thing that caught my attention here, Glen, is that when you do use a relatively short term entry level look back period, I mean, you could get a hell of a lot of false signals because a lot of markets are prone to trade in ranges, and I worry a little bit that you might get stopped in and out a few times. But again, pure speculation. Have never tested this combination myself. So these are things that I caught.
There are always trade-offs, and when you think about it, is that when you shorten up your window, you have let's say only look at it 21 days. This is that in some sense what you're saying is that I want more trades. I don't want to sit on the sidelines as often. I want to get more signals. And you can say and it will be successful at generating more signals. The problem comes in is that you're also going to get more false signals. If, on the other hand, you sort of lengthen up your program or your look back period, you're going to get fewer signals. Okay. But then the likelihood that you're going to get a false positive is less. So And you're also going to get a little bit frustrated because you might see what on a trend system, you might sort of say, "Oh, look, the trend looks really great. I should be in. I should be in." But your model, because it's has a longer look back, it may delay your actual entry. So there is a psychological component of what you're building. And there's also constantly a trade off. So you have to ask, well, do I want to be active or less active? Can I live with the period of inactivity? And what's my tolerance for false positives?
Yeah, no, very important points, actually. My final point to you, Glenn, would just be try a few different combinations, just see what they're like. And maybe if you want to use a 50-day low, which is probably perfectly fine, actually, then try and go a little bit further out in terms of the look back period for the entry. So you become kind of a longer term investor, I think. The only other thing I would also say is that I do think that there's always a bit of a danger if you concentrate your trend following to one kind of sector, because it's going to be highly correlated. And so you're not really going to get the full benefit of trend following. It's better than probably not doing trend following in your stocks, but the secret sauce partly of a trend following system is the fact that we have so many uncorrelated markets in our portfolio. So be aware of that. Okay.
And that is a critical point I think you make, because I was looking at and I had a request to do some analysis on some ETFs, and we were looking at, okay, what happens if I add in sector ETFs and country ETFs, and you find out is that okay, I want to increase the diversification, I want to increase the number of choice sets, but I wasn't getting a lot of change in the performance of the portfolio as I added in these new assets. And the reason why is that while there's some uniqueness with sectors, there's also a high correlation, so that oftentimes you get a lot of the signals across sectors all coming at the same time for this particular model that I was looking at. And so it's really important, if you're trading ETFs, that you include things that by definition will not be correlated.
Yeah. And actually, I would also say, Glenn, go back and listen to my conversation with Jerry from last week, because that's actually one of the things we touched on, that within his single stock universe, he makes a great effort actually to make sure that they are somewhat different, even though they're all equities, but they are somewhat different, like, Beyond Meat and Tesla and Moderna and stuff like that. They're definitely different drivers for those markets. All right, now we're going to get into some really interesting stuff that you brought along, Mark. As always, I'm just going to try and catch on to your thoughts and try and come with a few sensible inputs here. But I'm going to let you drive this a bit. And as I said, these are slightly different topics, but they are very relevant for the overall conversation, both for investors, but also for trend followers. So the first thing you wanted to bring up is just central bank issues. You didn't give me much more than that. So let me pass it over to you and see where we're going to go with this.
Well, I think that as we talked about at the beginning of the podcast, we talked that the topics stay the same. It's the intensity that changes. But let's be more precise when we talk about intensity. We'll say that the level of uncertainty associated with that topic changes. And there's a great quote by Keynes in his general theory. He talks about the extreme precariousness of the basis of knowledge. And so that because our knowledge is very precarious, there's a lot of uncertainty, that our estimates of prospective yield are very difficult to make. So forecasting is hard. And I've probably spent a lot of time trying to analyze or trying to deal with the uncertainty issue through the years. And I think trend following is an attempt to fight against the lack of knowledge and uncertainty. And when you think about it, and we'll tie this back to Fed and monetary policy in a second. is that in a simple world of uncertainty, there's a single path. You say, yeah, we know exactly where the world is going, but there may be some, sort of bounds around that. There's another level or a second level of uncertainty is that, well, we know that there could be a good path or a bad path, that there's two paths, so there's a juncture in where we can go with policy and choices. And then you get into higher levels of uncertainty. There could be 3 or 4 levels, or there we can't even determine what are the different scenarios or paths that we have. And if you look at right now, is that we have a very complex period, because we've got tapering going on, okay, which has started. Fundamentally, is that we know that one of the objectives of quantitative easing is that it would be able to lower interest rates and obviously drive up, bond prices. You get a wealth effect. Well, if we're starting to reverse that through tapering, albeit tapering is not the same as reducing the balance sheet, we're going to have to see prices, or we should expect to see bond prices go up. So that's going to put a lot of pressure on the market, as one of the key players is no longer present. And I think that markets are probably aware of it in the fixed income side. Equity markets may not be.
I'm just going to interrupt you here because I wasn't sure whether you really meant that. Did you mean that bond prices are going to go up or bond yields are going to go up?
So I said bond yields are going to go up.
Right. Yes. Okay.
So I was going to say that the prices were going up in quantitative easing.
Right.
Now that we're going to quantitative tapering, we're going to have the opposite effect.
Right.
So this is, and I think that we really don't know what the impact would be. And I probably would sort of say that especially equity markets don't seem to be thinking a lot through what the impact of tapering would be. Second of all, is that you could sort of see is that we've had a massive change relative to the summer on what we expect will happen with the Fed in terms of actually raising interest rates. Now we're sort of anticipating, if you look at the Eurodollar futures or Fed fund futures, 2 to 3 increases in 2022, the first one coming at least by mid-year. So this has been a radical change in how we think about Fed policy. We're seeing that the periphery central banks are already raising rates, especially in, let's say, Eastern Europe and some of the emerging markets. Exception is the wild card is always Turkey. We have other central banks, as a Bank of England might raise rates. We have reducing of the balance sheet of Bank of Canada. So we're in a significant inflection point, and that creates uncertainty and also creates opportunity. A perfect example is that when you look at the Treasury complex, is that a lot of people who are trend followers, they might trade just to 10 years, or a very liquid market. They've probably skewed trading to 2-year. And here we look at is that we've had a lot of price action in the 2-year Treasury. So there's now a tremendous amount of differences in how you trade along the curve and where you will see opportunities. And that even applies to back month Eurodollars, is that from a trend follower's perspective, a lot of people sort of avoided the front end of the yield curve for the simple reason is that if you're all close to zero interest rates, there's no activity to really sort of by which to base a trend on. So therefore, your trading was avoided. It was almost as though that you had to reallocate that capital, or if you kept that capital, you were not getting any signals. So we'll say the dynamics of where opportunities are going to come from, the dynamics of what those opportunities would look like, that has changed radically in the central bank area. And the area that also sort of fits in with this is that it's all going to create more volatility. So first is that if you end tapering or you end the purchasing by the Fed, well, this large player in the market is no longer going to be a consistent buyer. So that means markets will be driven by the expectations of other players on the margin, which means if those players change their views from one direction to another, that will create volatility. And finally, is that I think this is really going to be having affect a lot of trading. Is that if the Fed stops being the large buyer that it is, it's going to have a tremendous impact on liquidity in the treasury markets. If there's less liquidity in the treasury markets, then that's going to create more volatility and more noise in any kind of trading. An interesting study that was done where they were looking at the top of the book liquidity across the interest rate and bond complex, not only in the US, but in Europe. And we'll say, especially in the front end, is that liquidity is down over 50%, 80%, 90%. For front end treasuries, it's down 50%. Liquidity is about the same on the top of the book for 30 years. But in general, is that there's been a significant decline in liquidity across the interest rate markets. And what that means is that if people start to change their expectations quickly, they will not be able to get the trades that they want done, which means is that prices are going to have to adjust. And for the trend followers' perspective, that creates noise in your model. Because if, let's say, that the intraday high and low range gets larger, well, if you use any type of average true range, if you look at measuring volatility by using some other estimate than end of day closing prices, that's going to have an impact on that volatility measure. And if, let's say, it translates from one day to the next, well, then that means is that the trends that you're going to be looking at are going to be harder to understand or to extract from the market because of this higher volatility. So there's other effects when we think about the Fed taking activity. There's, on the one level, you say like, okay, they're going to be doing less buying. We're going to sort of see interest rates go higher, but there are also secondary effects or second order effects like liquidity that may affect how our models actually behave.
Yeah, no, I think all of those are very important points and well taken. I think one of the things that I think of when I think about these, one of the points that's sort of stood out for me is this sort of change in expectations that you talked about. And I think for a lot of investors, when they build their model portfolios, and I'm not specifically talking about trend followers, but I'm talking about the really big institutional investors, I think there's a lot of expectation as to what central bank policy is going to look like in the future. And I think a lot of that expectation is, well, it's not going to be vastly different from what we've seen in the last 10 or 20 years. And what worries me a little bit is that in history, you actually do see examples of suddenly something massively change in terms of, policy, so to speak. And you could say, well, why would they suddenly change their stance on certain things at this point in time? But I think sometimes we forget that we have lived in a relatively peaceful world for a long time now, but we are starting to see sort of the beginnings of, let's call it, quote unquote, civil unrest even in the Western countries. We saw some of it last year. We're seeing some of it now, which is, somewhat related to what's going on with the COVID situation, vaccinations and all of that. But I think we forget and underestimate that sometimes even these authorities like central banks, they can be forced to change their opinion or forced to change their policy by things that's happening in society. And I don't know, I don't have anything specific to base it on, but I feel, and maybe it's going back to kind of reading the book, The Fourth Turning, a while back and having talked about it on this podcast, actually, where they talk about these societal cycles and changes and where it looks like we are in this kind of decade where really societies will change and transform. And if you go on by the work that they did in terms of their book, this is also usually the time where you see some kind of large-scale crises taking place at the same time, and that might then lead to these quote-unquote U-turns in policy. So basically what I'm trying to say is I worry that the financial system, meaning how investors are invested and how the plumbing of the financial system is working, is very much relying on that there should be no major surprise from central banks. And usually when you put all your chips in one area, these changes or these surprises tend to come. So that's kind of one thing. And we've talked about this, of course, before, is that is kind of where the strength of trend following lies, because we don't have any expectations of anything. So if the policy changes and the markets take a completely different direction, well, we will adapt and adjust and we'll, just business as usual, really. Painful maybe for a period of time, but business as usual. We've been through these things many, many times.
Right.
So that's some of the thoughts that I took away from what you had mentioned there.
Well, I think that when we sort of say that trend following is non-predictive, I think that we're selling short the nuanced view of what is the importance of trend following and what it does and what it doesn't do. Okay.
Mm-hmm.
And a couple of ways in which we could go down this path. But right now I'm believing trend following is the fight against knowledge and uncertainty, we'll call it, or the lack of knowledge and uncertainty.
Right.
A perfect example is that let's look at the dollar. Dollar is DXY index. The dollar is starting to improve, and some people are scratching their heads. What's the reason for the strength of the dollar? And we'll sort of say that the dollar, like most other financial markets, is forward-looking. Mm-hmm. And the forward look is that there's going to be a change in Fed policy vis-a-vis other central banks, such that there's going to be a reason for investors to want to hold dollar-denominated assets. So it means that that rates, in some sense, are going to go up. Now, this is a very forward-looking view of the world. Now, the people who are scratching their heads are the ones who are sometimes the fundamentalists who are looking at the data. They're looking at, but the data that they're looking at in the fundamental side oftentimes is backward-looking. So we don't have, if you look at just the balance sheet of central banks, it still suggests that the Fed is very accommodative. If you look at the real rate of interest, it's very accommodative. So those fundamentals are backward looking. Now, a trend follower, because it's not using all that fundamental information, what it actually is doing is looking at what our prices are telling us today. And if those prices today oftentimes have this forward-looking expectation, it may be better able to extrapolate what is going on than the fundamental modelist. So the fundamental modelist is still trying to play catch up to forward expectations. And that's not always the case, but we'll sort of say for a lot of people who are just using backward-looking information, they're not being able to sort of account for this forward-looking bias right now. And here's a place where the trend follower is actually doing a much better job of fighting uncertainty than maybe the fundamental person. I'll go this a little bit deeper. Is that that the buzzword that a lot of people are talking about in systematic modeling is machine learning, and is coming from as an economics background, we'll sort of say that I'll say that I come from a culture of econometrics, or that's where I was taught. And what you sort of say that there's a fundamental difference in the problem that machine learning is trying to solve versus what an econometrician is trying to solve. The econometrician is saying, is this relationship that I'm trying to measure, is it causal? And given it's causal, can I then use that to make some judgments or forecasts about the future? The machine learner sort of doesn't ask that question at all. He just asks a simple question: is my model accurate? I have techniques that I think take in a lot of data, and it's an attempt to try to say, can I improve accuracy of some prediction? Now, when you look at a trend follower, is he looking for a causal relationship, or is he looking to be accurate? And I would sort of say that trend followers follow more in the camp of decision science and machine learning right now, because they only ask the question: is my model accurate? Is my prediction about, or my action that I take associated with trends, is it correct? It doesn't ask the question, is it causal? It just asks, does it do a good job?
Yeah.
And I think that's and especially if you're sort of trying to deal with a period of uncertainty like we have now, then the trend follower sort of said, like, well, how do I deal with uncertainty? I just try to sort of say, is my model more accurate in a sense? Is that if I say that I think that prices are going up and that's the trend, am I actually making money by following that trend?
True.
So, and this gets into, I think there's also a certain amount of precision in trend following that you don't sort of see, and especially when you read or listen to the talking heads across the media and across business news. So the trend follower has to be very specific. So he doesn't say, well, let me tell you about what I think of Powell. Let me tell you about what I think of Fed policy. All they sort of say is that, well, what is the price doing, and what action should I take from that? Now you could add sort of your own sort of fluff in terms of talking about it, but the idea of trying to solve uncertainty by talking through a narrative is not relevant for the trend follower. And this reminds me, in sort of side work I've looked at and studied. There's a person named Sherman Kent. He's a Yale professor in the 1950s, and he joined the CIA. Okay.
Mm-hmm.
And his job at the CIA was to try to sort of improve the forecasts that were being generated from the analysts. And so he worked on what I call words of estimative probabilities. And we could play a little bit of a game here, because what he wanted to do is he wanted to sort of say, we got to convert the language that you use in your report into probabilities, or at the very least, we have to understand what the probabilities are associated with the words you use, because if you use different words or have different meaning to those words, you might get a very different action. So if I say something might happen, what do you think the probability of that actually occurring?
Yeah. I mean, actually, just I don't know where exactly you want to go with this, but it reminds me of something that Annie Duke wrote in Thinking of Bets, and that is when people make these statements, what you really should ask them is, do you want to bet? Do you want, how certain are you about this?
Yeah, that would be the extreme, is to say, are you willing to put money on it? So, but
not just your honor.
Yeah. So for example, and there have actually been recent studies. Harvard Business School did a study, and there's a professor, I think, at the University of Illinois who's repeated this studies of Sherman Kent. So Sherman, what he did is that he looked at all these words, and then he asked people to sort of say, well, tell me what you actually think the probability is. So
might has a probability.
Yes. So the word
might.
Unlikely, they said, like, most people think that means that there's still a 20% chance of something happening, even if we say unlikely. If I say it's likely, it's probably about an 80% chance of happening. Now, the interesting part, if someone says, well, I think the Fed, this might happen with the Fed. Well, the median would probably be 50%, but the range is between 0 and 50. So when someone says something might happen, they might only give that a 10% chance. And if someone says, well, I think this is a real possibility, they only think that it's probably likely to happen 2/3 of the time. Mm-hmm. Now, where are we going with this is that when you think about trend following is that by saying that there's a sort of digital answer. It's yes or no. I'm willing to bet if because because I look at this trend and I think that the price is going higher. You sort of avoid this imprecision of language and the imprecision of knowledge. You're actually sort of converting, sort of what you're seeing in the markets to an actual bet, as opposed to using sort of the fluffy language to describe something. And when you use that sort of fluffy language, what you're doing is it gives you an ability to not really be precise, give you a little wiggle room on what you actually mean. And it actually hurts your analysis in the long run.
Yeah, no, absolutely.
So you got to call me out if I said, I think that might happen. Well, so, what exactly does that mean in terms of probability?
Our conversations going forward, Mark, is going to be completely different. Could actually be more fun, I'm sure, for the listener.
But think of this is that, and it'd be interesting to ask some of our other podcasters, is when you sort of use the word likely or might happen, how they would answer what's the probability of that occurring. Or if someone said, I think that, the Fed might raise rates by June of next year, what their response would be in terms of what's the probability of that actually happening if someone told you that?
Well, of course, in secret between you and me, Mark, and I'm sure the other ones won't pick this up in this conversation. You can, of course, prepare a few of these tests when we do our big group conversation in a couple of weeks, which I announced last week, and it's now final. So we will be doing a recording, probably lasting a couple of episodes in length, where we're going to all get together and we're going to battle out and hash out a lot of our differences in terms of trend following. But of course, we also want the audience and our listeners to join by asking questions. So by all means, already, please do start sending your questions in, and I'll do my best to make sure that we get some of those included in all the topics. But I think that could be quite fun if we can do that now. Of course, I'm sure they will be prepared, having listened to us today, Mark. There are some other things you brought up, and I just want to make sure we give it a little bit of time if you want to. You talked about equity markets, you talked about COVID trends, you talked about inflation. I think inflation could be interesting to hash out a little bit more in detail. What are the things you're thinking of when it comes to these points and these issues at the moment?
Well, let's talk a little bit about inflation, because I think that there's a tremendous amount of misinformation about inflation. And I think that you'll have in the United States, for example, that they've been saying, well, turkey prices are really high. And so, see, that's inflation, where they'll say that the gasoline prices are high. It must be that oil companies are gouging consumers. So what they'll do is that they'll take a single price and they'll extrapolate that into what is inflation. And that's not inflation. That's a relative price change. And what we found is that when you have higher inflation, one of the big problems, it creates noise. And the noise is that it makes businesses it's harder for them to make effective decisions. Mm-hmm. Because, they say, well, should I raise my prices or not? I see other people raising my prices, but is that because they have higher demand or because there's inflation? The Fed is, how do I change my expectations? And this creates sort of a noise effect and makes business decisions more difficult, which creates actually dislocations, which are often what we actually exploit in the marketplace and in trends. Now, a thing that you really look at this is that if you look at the relationship between, inflation and bonds right now, it's not very strong at all. If you said, I'm going to look at the trend in inflation and then sort of extrapolate what should happen in bond prices, well, you'd be losing money if you looked at that cross-asset relationship. On the other hand, is that if you look at commodity prices, is that the inflation is probably, to some degree, not really representing the beta of commodity prices is much higher than one. And what you find out is that anticipated inflation is not the real killer. It's the unanticipated inflation. It's the deviation from trend that really sort of drives markets. But oftentimes, again, from the inflation stories, is that people say, well, because earnings are can be adjusted, is that equities could actually do better in an inflationary environment than bonds, which are in nominal prices. That's true, but if you look at the decile equity prices over different inflation periods, is that the high inflation environments is not really good for equities. It's not something that you should be welcoming at all. It is going to have an effect. And even on the commodity side, this is that you say like, well, inflation is higher, so therefore commodities are going higher. Well, I looked at the FAO information and on real prices. What you find out is that real commodity prices are at some of the highest levels we've seen since they recorded this. So we're at multi-decade highs on real prices. And from when you say cultural dislocation, it's not so much that inflation is higher, but if food prices is higher on a real basis for emerging markets, and a larger portion of their income budget is associated with food, this actually has a real big impact on social and cultural dislocations.
Yeah, agree. Very interesting. And actually, the topic of inflation is interesting. And I think the point you made is actually quite relevant. I think because of the increased level of prices and therefore quote unquote inflation, I think a lot of people are now starting just to look back in history and say, oh, are we in the 70s or are we in the 40s and what's going on there? And you brought up a really interesting point, because I think a lot of people will naturally gravitate towards the 70s first because it's closer in our mind. Some of us actually, lived through it, so to speak. And there was generally, you could say that interest rates and inflation were much higher correlated during that period of time. They hiked interest rates as inflation was increasing to fight it. But the 40s were very different. In the 40s, there were a complete disconnect between inflation and rates because you had a period of financial repression.
Right.
So those two are very interesting, because I think it goes to show the uncertainty that we actually don't know exactly what the 2020s are going to look like. We might be lucky in a forecast saying, well, we're probably going to have some inflation during these 10 years, but we actually don't know. As you pointed out, we don't know exactly what that's going to do to interest rates or to any of the markets for that matter. So coming back to kind of trend following, where we don't need to know what's going to happen. Again, we as trend followers, we think that's such a powerful ally to have on your team. But I think this is going to be a debate. And again, going back to my point previously, I think that a lot of these big portfolios, whether they be pension funds, sovereign wealth funds, or whatever, wealth managers of different sorts. Unfortunately, I feel that there's a lot of money being at the moment invested in a very similar way, kind of relying on the status quo. And I worry that we may not get the status quo, and this will, give some real trends, quote unquote, in the markets. Maybe not to the upside in some of these financial markets, bonds and equities, and that's going to be very interesting.
Well, I think that we're getting to a period also of more introspection by central banks and by investors in general. So there's an interesting paper that was written by one Fed economist, Jeremy Rudd, and basically his conclusion was is that what is the link between inflation, inflationary expectations, and money? And at the end of the day, he basically came to the conclusion to say, we really don't know. That the links that we think that we build models on often don't exist. And this doesn't, I don't want to denigrate all the economic research, but in a changing world, is that we could sometimes, and the process of investigating and in process of being scientists, we find out is that some of the relationships that we thought may exist may not. And we'll sort of say that the investor doesn't always have the luxury of being a scientist to say, like, well, I'm going to look at this as a hypothesis, and I'm going to test it, and then I'm going to come to the conclusion that I'm wrong. The investor has to live in a world where he has to try to make money or protect his portfolio. So he has to use other methods to try to improve his accuracy, not to try to understand causal relationships. Getting back to what we said is the difference between the machine learner, data science person, and the econometrician. But, I would sort of say that here's a perfect example is that we're getting higher inflation. But, from the Fed's perspective, they're really not admitting that this is caused by increases in the money supply, because what we've seen is that the money multiplier has fallen out of bed. It's the money multiplier has declined significantly. So they're saying is that, well, we probably thought that at this kind of increase in money that we'd have higher inflation. We didn't. Now we're having higher inflation. And now so what is the relationship that we should expect between inflation, money, interest rates? We really don't know. And I think that this is, again, the initial part when we started the podcast, precariousness of our basis of knowledge, as Keynes would sort of say, is we're highly precarious in our knowledge. And so therefore is that it's not that trend following is the be all end all, but in a highly uncertain world, it is a process that works and can protect you against this our lack of knowledge or the uncertainty that we face. That here's some rules that we could follow to offset the precariousness that we face.
Yeah. And actually what it comes down to, which is, I think, to keep it really simple when you think about portfolio construction, is to how can you put together a portfolio where you, on one hand, can participate with as much, how should I put it, not speed is not the right word, but where you can have as much upside as possible, participate in all of that, but then at the same time you need the protection. So participate and protect is really what it comes down to, and there are only very few strategies that can deliver that protect and at the same time allow you to participate. So it's very interesting. Another thing that's just quite interesting that I notice is that when we talk about expectations, we talk about sort of new environments. When you look at and this is obviously based on US data, or not obviously, but it is based on US data. If you look at the real yield, so the nominal yield less inflation, we are now already down in the negative levels at the same level as we had in 1973, 74, when we had the oil crisis. And so now the 40s went much further down. At certain points, you had negative 15% real yields because of massive inflation and financial repression at the same time. So it'll be very interesting to see how, and this is the other thing. We talk a lot about sample size in our conversations often and how important it is. When you talk about sample size for these kind of extreme moves, we don't have a lot of sample size. We have a handful maybe at best, but that's stretching it down to, back to, late 1800 something. So again, very interesting stuff going on in these markets, and with this inflation roaring its head now.
Well, the sample size problem is that there obviously is the behavioral bias of small sample sizes. Is that what we do is we find one or two historic events and then we extrapolate that, or even like people say, well, this is how prices behave during the upswing in the business cycle. They just say, well, wait a minute. how many business cycles do I actually look at to try to get this? It may be in the United States only a limited number, and they don't really extrapolate it to other countries. So the whole idea of sort of saying is that, well, this is how markets will behave, in the upswing in the business cycle. I think that you can say, I have some data, I have some theory that says that this is how it should behave, and the data seems consistent with my theories. But the actual size of the impact it's hard to extrapolate that. And if you had to put bounds or sort of ranges around it, it's a pretty tough world. So I think that's not something that you got to be. It's not something it's not something that you can put a lot of stock in.
Right. No, absolutely. Now, the last few points you wanted to bring up, which we certainly can just sort of pick those who you feel are most relevant. You talked about overriding models. You talked about stop loss and the it's sort of as last resort strategy. You talked about drawdown minimization. You even went on to talk about tracking old and new models, and then some behavioral biases. What would you like to dive into here?
Well, this actually came out from a conversation I had with a manager. So we were doing a review, and we had this, and so has some great models, smart guys, good researchers. I think that they've good pedigrees in terms of what they have. And I'm looking at their track record and said, like, well, what went on here? I said, and with this one period in their track record, it was right around March 2020. Right. And he said, like, oh yeah, this is that we overrid the model, So he said because we had such unique situations, we turned off a portion of the model, for the equity markets. So, and then I said, okay, I got to ask the other question. What happens if you didn't turn off the model? What would you have? And he said, like, oh, well, instead of having a negative period, we would have had a positive. so he said, like, oh my God. He said, well, we can't really do that because, our from a compliance perspective, and say this is what we would have had if we followed the model. Right. And then I said, okay, okay. Once you turned off this portion, so because you said that March of 2020 was in the middle of the month was so unusual. I said, when did you turn it back on? He said, well, we were waiting. We didn't know what the perfect time was. And then I sort of say, like, he said, but we're never going to do this again. So, and this is, I think, a much longer discussion. And their thought process was actually seems very rational. It makes a lot of sense. We had such unique events occurring with COVID that we felt the signals we were getting in price did not make any sense. The signal that no one understood what was going in the market. So the best thing we could do is just sort of say we're gonna turn the model off. And in some sense, if they followed the model, they would have been much better shape. And then once they did the turn off, they probably didn't really sort of sit down and talk about it, like, well, what are the conditions where we're going to reverse this decision and put the trades back on? Because, well, all of a sudden, when you look at the market, as equity markets fell out of bed, and then they started coming back really quickly in the end of March and early April, the stock indices. You say, like, oh, look, we got COVID, we're going to have millions dying, and now the stock market is going actually up. This doesn't make sense. We better wait. And so they waited and they waited. And so it got worse and worse. And so there's a whole issue of, we started having a further discussion to start saying is that, well, they've made some changes to the model. And I said, well, do you track the old model? Mm-hmm. So can you say, what is the old relative to the new? And can you say that your enhancements actually added value? Or would you measure that you add value with your quote unquote new or your additions relative to what you had in the past? Now, on one hand, this is a very difficult game because, okay, you add a new model and there could be very good reasons for it, but the path that occurred in the actual market prices may have been more favorable to your old model. Does that mean that the new model is wrong? It's hard to say. And some people say, well, once I throw out my old model, I don't want to go back and look over that because then I get into the second guessing issue. So here you have the whole one of the key problems with being a systematic manager. Should you override? What are the conditions for an override? If you do override, when would you sort of reverse your override? If you have a model and now you're going to change a model or add a new model, should you track how it performed relative to the past? And if you track it to the past, is that what do you do with that information now that you have it?
I completely agree. I mean, these are actually quite difficult questions. I actually think we should put them down as some of the topics we should discuss when we all get together, because I mean, even within our group, where we are kind of diehard trend followers, we do have differences in terms of being 100% systematic or 99.9% systematic, as people will know from listening to our conversation. So I think this is interesting. And what also makes it really relevant and interesting is, of course, that in 2020, we know for a fact, or at least listening to some of the allocators to this space, at least they have come out and said there were several of their trend following managers who made discretionary decisions in terms of their model, whether it was the risk level or whatever it was, but there were overrides,
Right.
quote unquote. Yeah.
And then when you even, so it's even more difficult than the fact of just saying is that, well, don't override or override, that it's a yes, no question, because there are people who overrode and actually they probably added value. There are people who overrode and it didn't add value. And the issue comes in is that, okay, is a macro event worthy of an override? Which I'd sort of say, like, well, if you really believe that trend following is an attempt to sort of deal with uncertainty, it would seem as that you shouldn't override for a macro event. On the other hand, if let's say we talked a little bit about treasury liquidity, or if you sort of said that there's a massive change in liquidity on the top of the book, or let's say that the Fed or central banks are involved in financial repression. So now I have a model and I'm going to change the weighting, or I'm going to reduce exposure to a market or stop trading a certain market because of liquidity considerations or because of repression considerations. That's a different question. So the issue of, say, I always follow my model is actually much more nuanced, because you have to ask the question is that, well, are there different conditions that you should sort of address here and think about? And this applies even so the question that applies for very large money managers is actually the same question that even for a lot of listeners who might be trading their own portfolio. You have to ask the question, this is that, what are the conditions where you say, I'm going to turn it off? And the questions may not always be, I'm losing money, this isn't working. You have to ask the question is that, are there events or situations that would suggest a switch? And then the question comes in is that, is turning off the same as saying that, okay, euro dollars is all close to zero in the front month. I used to trade euro dollars because of Fed activity. I'm going to stop trading that. Is that an override to your system, or is that just a portfolio rebalancing? The person we were talking to sort of said, well, I overrid the system. You could sort of say, like, well, we made a portfolio rebalancing away from global equity futures, and we rebalanced it to zero. So is there a difference between those two decisions?
Yeah, no, absolutely. These are important, and I actually think that they are extremely relevant to those in our audience who are doing this themselves, because I think this is one thing that you can't backtest, and that is experience. And I think that's one of the benefits you get and I've said this before, I think there are merits to trying to do it yourself for sure, but I also think there's a lot of merit to saying, actually, I am going to give the money to someone who has done this for 30, 40, 50 years and let them deal with this, because there is a little bit more to it. And doesn't mean you can't educate yourself about the process and all of that and be very close to it, but it's often these decisions at extreme points in time that can make such a big difference.
And you could get into the very micro level. This is that I have a signal to go long or short, but the market seems very illiquid at the time of the signal. Should I just hold back the order for a couple hours or days? So there's a micro and macro. And I guess that an interesting paradox is that if you never change your model or you never override, okay, well then you can then it's very hard to test whether that was a good decision or a bad decision because you have nothing to compare it to. On the other hand, if you do override, you could always then go back to the model and say, if I didn't override, what would I have made? And I could say, here's what my performance with the override, here's the performance of not overriding. So you can measure your success or failure if you do override. If you never override, you can never determine whether that was actually a good choice or not a good choice because you have nothing to compare it to.
No, true. But of course, as soon as you start going down that path, I think the likelihood of you making too many of these decisions is very increases dramatically in probability.
And we could sort of say the final thing is that, well, how many overrides does it take to become a discretionary manager? so if
some would say just one.
Well, that's an interesting question. Is that if you have let's say you're a manager for 20 years, and let's say that you've taken, let's say, one override every 5 years, are you a systematic manager or you're a discretionary manager? And similarly, is that if I say like, well, I give my traders discretion on how to execute, I do this kind of things, and I use my expertise to adjust the weightings in my model across markets. Is he a systematic manager or is he a discretionary manager? And what's the space in between? And this really gets into the tough issue because we'll sort of say that investors oftentimes will say, I want to hire a systematic manager. But one of the critical questions they often get to is that they'd say, I want a systematic manager, but I feel a lot better if, let's say, he says that he might override at certain times, that he still says that I might turn it off under some situation. And he goes like, well, I want systematic, but I don't want all systematic. I want to have some. I want to have him some discretion that he could make some choices. So investors are oftentimes they want to straddle it. They say like, I want a systematic manager, but I want to give you discretion to make overrides if that's going to be a good decision.
Exactly. Well, that's the whole point. Speaking of decisions, I know we've sort of gone through your topics and there'll be more to discuss in a few weeks when we all get together, I think, on some of these points. But I do this little study by where I look at we talk about making decisions, right? And one of the things when we obviously hope that people will include trend following in their portfolio. So the question we often get is, okay, so how much should I put in trend following and how much to equities and how much to bonds? And I just want to illustrate how interesting that question really is, especially when you think of the stocks and the bond portfolio. So what I do is I start at two extreme points. So I go back about 20 years and I start just before the tech bubble. If you were having to select the optimal portfolio, and this is just based simply on Sharpe ratio, so nothing too clever here, what would your allocation have to be just before the crisis of the tech bubble? And there you see that and this is around September 2000, you should have put 66% of your money in the World Government Bond Index, 23% in the World Equity Index. And then, of course, I use our own DUNS program as the benchmark for trend following, and that gets an 11% allocation. But then only 2 years later, you get the low of the crisis, and then again I look at what would the optimal portfolio have been if you had started at that point in time. And what you see there is that your bond portion, not surprisingly, goes down to around 49%. Your equity portion, not surprisingly, goes up to 41%. But your allocation to trend following actually stays more or less the same. It sits at 10%. So kind of a nice balance or a nice consistency in the trend following part, but hugely difference between how much you should have had in equities and how much you should have had in bonds at these two extremes. And then I followed up by saying, okay, well, let's look at the other big crisis we've had in the last 20 years, which is from November 2007, where you could have started investing just before the crisis, or it could have been in March 2009, just at the low of the crisis. And there you get some even more extremes. So in November 2007, if you had to allocate to the optimal portfolio based on Sharpe to these three assets classes or assets, you should have put 28% in government bonds, and you should have put around 44% in the equities, World Equity Index, and around 28% in Dunn's trend following program. And then at the low of the crisis, the bond part actually completely goes away almost. We're down to 7% just that you should have had in bonds since 2009. You should have had 74% in equities and 19% in our strategy. And so again, there's definitely more consistency between the two allocations to trend following than there is between bonds and stocks. But it just shows you how difficult it is to make these decisions, and going back to your point about precision and all of that. So when people think about allocating to trend following, we're not thinking that you're going to get it right or you're going to get it, very precise, but it gives you some indication at least in terms of what the allocation should be in an overall portfolio between these three assets, which most people have at least two of them. Now, Mark, as people will know by now, we are speaking on a Friday, and therefore performance looks pretty good for trend followers so far this month. I'm not sure it's going to be the same when we look at these one day later. But anyways, as of Thursday evening, the Beta 50 was still up 80 basis points for the month, up 12.5 for the year. SocGen Trend Index, CTA Index, up 72 basis points for the month, up 10.67% for the year. And the SocGen Trend Index up 1.25%. Up 15.36 for the year so far. The short-term index is is up 7 basis points for the month, up 2.36% for the year. But as I said, the numbers will be very different, even for the World Equity Index, which was slightly up as of yesterday for the month. But that's also going to be down for the month once we finish with this day for sure. We're going to wrap up the conversation. As mentioned earlier, if you wouldn't mind, send this link, toptradersunplugged.com/share. Send that to 3 of your friends. Let's see if we can't continue to grow the audience. That would be fantastic. Next week, I'm joined by Rich. He's back. So that's going to be also, as usual, fun, educational. I am excited to hear what his topics for the week will be. If you have any questions, of course, you can always send them to us, info@toptradersunplugged.com, and we do our best to get them debated, discussed, as soon as we get them. From Mark and me, thanks ever so much for listening, and we look forward to being back with you next week. Until next time, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.